Hello friends, how are you? Hope so you will all be healthy and happier. Today I will discuss different types of loan. So I will guide my best to inform you. Here we start different types of loans. Borrowed money can be used for many purposes, from funding a new business to buying your fiancé an engagement ring. But with all of the different types of loans out there, which is the best and for which purpose? Below are the most common types of loans and how they work. Number one, personal loans. Most banks, physical and online alike, offer personal loans, and the proceeds may be used for virtually anything from buying a new smart TV to paying bills. This is an expensive way to get money because the loan is unsecured, which means that the borrower does not put up collateral that can be seized in case of default, as with a car loan or home mortgage. Typically, a personal loan can be obtained for a few hundred to a few $1,000 with the repayment periods of 2 to 5 years. Borrower needs some form of income verification and proof of assets worth at least as much as the amount being borrowed. The application is typically only a page or two in length, and the approval or denial is generally issued within a few days. Best and worst rates. The average interest rate for a 24-month personal loan was 12.17% in the third quarter of 2023, according to the Federal Reserve. But interest rates can be more than three times that amount. Advance APRs range from 9.95% to 35.99%. For instance, the best rates can only be obtained by people with exceptional credit ratings and substantial assets. People with bad credit can expect to pay more in interest fees. A personal loan is probably the best way to go for those who need to borrow a relatively small amount of money and care and are certain they can repay it within a couple of years. A personal loan calculator can be a useful tool for determining what kind of interest rate is within your means. Credit cards. Every time a consumer pays with a credit card, it is effectively equivalent to taking out a small personal loan. If the balance is paid in full immediately, no interest is charged. If some of the debt remains unpaid, interest is charged every month until it is paid off. The average credit card interest rate carried a 21.19% APR in the third quarter of 2023, according to the Federal Reserve, up from the 2022 fourth quarter rate of 19.07%, bringing it to its highest rate since 2018. Many credit cards offer promotional rates to sign up, with some going as low as 0% interest as an introductory rate. But those rates are temporary, and when the promotional period ends, they will return to their standard level. Credit card cash advances. Credit card usually include a cash advance feature. Effectively, anyone with a credit card has a revolving line of cash available at any automatic teller machine. This is an extremely expensive way to borrow money. Cash advances also come with fee, typically equal to 3% to 5% of the advance amount or $10 minimum. Worse yet, the cash advance goes on to the credit card balance, accruing interest from month to month until it is paid off. To take one example, the interest rate for a cash advance on the Chase Freedom credit card is 29.99%. Cash advances are occasionally available from other sources, notably tax preparation companies may offer advances against the expected IRS tax for refund. However, unless there is a dire emergency, there is no reason to give up part of your tax refund just to get the money a little faster. Revolving debt versus installments loan. The biggest difference between a credit card and personal loan is that the card represents revolving debt. The card has a set credit limit and its owner can repeatedly borrow money up to the limit and repay it over time. Personal loans are paid but once and repaid in installment over the agreed upon term. Home equity loans. People who own their own homes can borrow against the equity they have built up in them. That is, they can borrow up to amount that they actually own. If half of the mortgage is paid off, they can borrow half of the value of the house. Or if the house has increased in value by 50%, they can borrow that amount. In short, the difference between the home's current fair market value and the amount still owned on the mortgage is the amount that can be borrowed. Small business loan. Small business loans are available through most banks and the Small Business Administration. These are typically sought by people setting up new businesses or expanding established ones. Such loans are granted only after the business owner has submitted a formal business plan for review. The terms of the loan usually include a personal guarantee, meaning that the business owner's personal assets serve as collateral against default on repayment. Such loans usually are extended for periods of 5 to 25 years. Interest rates are sometimes negotiable. The small business loan has proved indispensable for many, if not most, fledgling business. However, creating a business plan and getting it approved can be arduous. The SBA has a wealth of resources both online and locally to help get business launched. That was the topic. We will meet in the next video. So bye for the next video.